He's written his own backtesting framework, and he's going to show us some results of trading. Again, 60-40-20. And just quickly, a couple of announcements. April 27th, which is next month, Thursday, April 27th, Brian is going to talk about risk and hedging. And Brian, you have a new monograph out on that. Is that correct?
Yeah, the presentation next month will be introducing a number of different hedging frameworks using different vehicles, futures, options to hedge both exit risk and then also to hedge catastrophic risk. And the framework and the analytics that we'll talk about will allow you to identify the cheapest hedging technique or vehicle that you can actually use to hedge that type of risk. So it was introduced in a new book that actually just came out. The print version just came out today. It's called Option Strategy, Hedging, and Risk Management, and it's actually. Hold it up? Yep. It's available on Amazon. It came out about a week ago in the ebook version, and the print version came out today. So if you're interested in checking it out ahead of time, you might get a little bit more out of the presentation. But either way, I'm going to cover what's in the book extensively next month.
Yeah, this is a really hot topic, risk and hedging, and we've had a little bit of discussion on the forum about it, and thank you, Glenn. And I'd like to have more than one meeting on it. So please take a close look at this, and then we'll continue in another meeting too, I believe, on the same topic. And is Tom Clark here? Oh yeah, Tom. Tom has an update, and we're not going to have time to go into it in any detail. But very briefly, you've updated your results.
Actually, let me get mine. Last meeting, we presented last year's results. We had 2 trades on this year. The January trade, I netted 7.5%. February 1.4. So it's still working.
That's on the bull.
That's the bull, yeah.
John Locke's the bull, which is a lot to be said when you're trading a strategy. Start out with a clearly defined strategy that's already defined. And Tom did that, and he's just got outstanding results.
Let me mention something about we talked last month about the stop loss and toss, and we kind of concluded that you needed a contingency order. I went in and played with it, and actually it looks like toss will take a stop loss order based on the mark of the credit spread. And it knows that the price has got to exceed a certain value to exit. I was thinking it wouldn't do it, but it does.
Very good. Thank you, Tom. And I think we can come back later to the bull and all of our strategies in review, but that's useful to know. The final time I'm going to take here before I give you to Mark is to say that Andrew Faldy, who is the inventor of 60-40-20, is giving a talk in May in New York, be a paid seminar on 60-40-20, on net zero delta. So if you find that you really want to get all the details from the horse's mouth, you can start by listening tonight, and Mark and Ryan will give you a decent explanation of it. But if you want more details, then call or email Andrew at afaldy@smbcap.com. It's in the I put it on the end of the announcement if you need that. Any other quick announcements before we give it to Mark? In that case, let's have a warm welcome for Mark.
Well, thank you. My name is Mark Mosley. If you don't know me, let's see. All right. My name is Mark Mosley. If you don't know me, I'm a full-time trader. I was a commercial real estate appraiser before I got busy with this venture, and I've been at this about 6 years now. Had a lot of false starts when I first started. a lot of knowledgeable appraisers said you need to understand the Greeks when I first started. And I was like, Greeks? I don't need any Greeks. But anyway, the longer I've been at this, I've realized how important they are. And I've taken several courses. I've taken Dan Sheridan's butterfly course, and I've taken a number of John Locke's courses. I learned quite a bit about the Greeks through taking John Locke's courses. The problem I had with John Locke's stuff is it was very adjustment intensive. And last summer we had Andrew Falvey give us a little talk at one of our meetings, and he introduced the concept of getting rid of all these adjustments. And the idea being, if your trade needs adjusting, you probably need to close it and be in a different trade. And so I've tried to apply that to my trading and have done very well with it. And so that and the whole concept of the 60-40-20, which we'll get into in a minute, gives you a very balanced butterfly. The concept of delta neutral, as traders, we don't know which way the market's going. Everybody's got an opinion. If you get 10 guys from Wall Street, you'll get 10 different answers. Nobody knows, and the experts get stumped all the time. And so the best approach we can take as traders is to enter a trade as a delta neutral trade. And so delta is a risk factor, and it's a directional thing. And so when you are delta neutral, you are able to withstand market movements in either direction for a good ways. And so let's get into it, and we will explain it further here. Let's see. Where is my mouse? Okay. So anyway, the rules are very simple for the delta neutral butterfly here. We enter the trade 60 to 80 days to expiration. We select the strikes having the deltas closest to 60, 40, and 20. Now, if you're familiar with how a butterfly works, you'll have a long leg on one end, you've got short legs in the middle, and long legs on the other end. And so we'll demonstrate this in a minute, but we will select the strikes corresponding to these deltas, and it will give us a very neutral butterfly with a very wide range of safety. So our exit triggers are as follows. Now these are Andrew's exit triggers. I've added a few, which we'll get into in a minute. So we'll exit the trade if the middle strike changes by 30%, or we'll exit the trade if the upper strike changes by 30%. And so and we'll also exit 30 days expiration regardless. So we enter the trade at 60 to 80 days, exit at 30 days. And so we have a little cheat sheet here as you're monitoring your delta values on your, it's mainly your center and your upper leg. Your upper leg is your 60, your center leg is the 40 delta. And so we have this little cheat sheet, which you might want to just print out and paste it to your computer if you're going to do this. But this would represent a 20% move, and this is just a caution indicator. I've held trades past 20%, and they were still performing fine. And Andrew has said 20% at times. He said 30% at times. When these deltas change by 30%, you're probably getting into the trouble zone, and you should probably just collect your profits and reapply the trade. And so those are the basic rules for Andrew's butterfly. It's very simple. It's much simpler than other trading systems. So just as an example of how this is done, this is a sample option chain from Thinkorswim. You can see up here, can everybody see this? We can zoom in too. Let's see. Okay, up here, this is 72 days to expiration. Okay, let me see if I can do this. Okay, and then over here, you'll see where I've got delta circled at the top of that column. There's a little drop. It doesn't highlight on delta by default. You have to go in there and change one column to delta, I changed the other one to open interest, but don't worry about that. The delta is really what we're focusing on right now. And so you can see that there's the 20 strike, and then down below is the 40 strike. And so the way I do that, let me see. Can't really point in the zoomed in. So anyway, you'll click once here on the ask. You'll click twice in the middle at the 40 strike, and then you'll have to scroll down to see the 60 delta leg, but you'll click on the ask on the 60 delta leg. And so down here at the bottom would be your order ticket. Once you've done all that, let me see if I can zoom in here. Okay, so this is your order ticket, and this is a representation of a typical entry on this. $4.55 debit for a 1 lot. That price jumps around a bit, but you know, I don't do really any market timing on entering these things. I just kind of jump in when you are 60 to 80 days to expiration. There's a whole lot of safety with these trades, which we'll demonstrate further.
Mark, can we explain this?
Sure.
People need to understand the basic order. And do people understand what this is? This is the entry to the trade.
This is your order ticket. Once you're teed up like this and you have this at the bottom of your screen, if you'll right-click over here just to the left of where it says butterfly, you'll get the confirm and send window, and it will give you the details of the cost of the trade. But this is essentially your order ticket in green down here at the bottom.
3 foot, all foot, and long.
So yeah, it's 1, 2, and 1 for a 1 lot. So you're short twice as many in the middle as you are long on the ends. Okay, I think we're okay on that then. So okay, now you'll notice this little padlock is open. If you so while the market is open, that 455 that we're seeing right there will tick up and down based on movement of the pricing of these options. Now, typically what I do is watch it a few minutes and see, and kind of get an idea of what's low and what's high for the current pricing, and then I'll try to I try to get the best price I can, but you'll lock this padlock. If you'll click on that, it locks, and you can change the price to whatever your limit.
So just to explain, this is basically your bid. So that's spread, because you have to pay. This is a debit credit. You have to pay them, and what he's doing is changing his bid around.
So anyway, move along here. Okay, so this is what a typical graph would look like. Now, I don't know if everyone is used to looking at these graphs, but it's very important that you understand this. Over on the left-hand axis, you'll see the 0 line. So this is profit and loss for your trade. And so, plus 1,000, minus 1,000. I think that's self-explanatory. Okay, across the bottom, these are all the possible prices of the underlying instrument, which in this case is the SPX, the S&P 500. And so when I printed this chart out, the S&P was trading at 2372.60. So that corresponds with this vertical line. And you'll see, let me see, I need my pointer again. Anyway, this is a typical graph. Let me see if I can use my pointer here. So you'll see where that little red dot is. Okay, if you were to follow that over to the left axis, it's right at 0. Well, we just put the trade on, so you don't expect to have made anything. But as time goes by, you can see these red arrows. This whole line will lift in response to the accumulation of theta, which is the time decay of the options. And so what we look for in these is a very flat T plus 0 line. This purple line is what's called the T plus 0. That's time plus 0, which is right now. T plus 1 would be tomorrow. T plus 2 is the day after tomorrow, etc. So when you enter this trade, this is what your typical entry would look like. Okay, and down here we have our Greeks on this trade. So you'll see the delta here for this trade. Let me zoom in again. The delta on this trade just starting out would be 1. I'm just going to not worry about the point there. It's really a 1 and a theta of 8. So we always want to see more money coming in the trade in the form of a positive theta than our risk factor. The delta is the risk factor. A delta of 1 is very close to 0. Plus 1 minus 1, that's all very close to 0. So we could consider this roughly neutral because delta is a very small fraction of theta at this point. So we're not facing any, I mean, you're always facing risk in doing this, but we're not facing a lot of directional risk. Just starting out here, the market could rip up 20 points or down 20 points, and we're still essentially at break even. So this is the first day of the trade, and we've got a case study coming up here, so we'll show you how it changes over time. Now, what I was just mentioning is the delta theta ratio. Now theta is what you're being paid for being in this trade, essentially, and delta is your risk factor. And so I have found through trading these that a delta theta ratio of approximately 50 to 60% is getting to be where you might want to consider taking profits and getting out of the trade. All of these exit triggers are really designed to get you out of the trade while you're still up money. You don't really want to be putting these things on and losing money. My goal always is to not lose a thing. Sometimes that doesn't happen, but most of the time, trading these, this has been the most flexible trade that I have found. So anyway, as I said over here, this trade is designed to be placed without regard to market direction. Most of the time, we have no idea which way the market is going, and so that's why we take a delta neutral stance at the beginning. This delta is a measure of directional risk. Theta is a measure of time decay. We always want to be collecting positive theta. Some of this is just what I've just been talking about. The closer we are to 0, the more tolerant we are of directional price moves. In practice, a certain amount of positive and negative theta, positive and negative delta is acceptable as long as it is small, and we measure that quantity with the delta theta ratio. And so I've seen them hit 50% and then pull back in, and I've stayed with the trade, and they've done just fine. But by the time you hit 60%, you're probably starting to get into trouble with your trade, and I would advise just exiting and putting on a new entry. So I just wanted to measure the other Greeks. When I first started trading, I heard other traders drone on about Greeks, and a lot of it went over my head. And really what it amounts to, all these Greeks are inputs to the option pricing. So if you think of the option pricing as a big, long equation and these various factors, we're not actually pulling out a pencil and doing algebra here, but they're factors we consider. And so two other Greeks that we don't think about a lot in this strategy, but I wanted to mention them. Gamma is the rate of change of delta. Now, as you get closer to expiration, things can get crazy with gamma, and so that's why we enter way out from expiration. I love to enter at 80 days because there's just virtually no risk from 80 to 60 days in your trade. In practice, you can maybe enter at 50 days. I've tried entering at 45, and I don't like the way the graphs look. So really, 50 or 55 to 80 days is kind of the sweet spot there. Usually, Andrew Faldy likes to exit at 30 days. That's probably safer. If you really want to push it, you might take it to 20 days to expiration. But, most traders advise taking profits early and reapplying the trade rather than trying to milk every dollar of profit out of every trade. The other thing we wanted to mention is Vega. Vega is a risk factor related to changes in volatility. It's hard enough for us to predict which way the price is moving, much less which way volatility is moving. There are volatility smile charts and all kinds of things, and that can get very confusing. And so in practice, we just put these things on. As long as we are positive theta, any injury to our trade from an adverse move in Vega usually it comes out in the wash and we're okay. So even though these things, and we'll talk about this a little bit more, but just know that changes in volatility can affect the value of your trade and hence the profitability. But as long as we're positive theta, it usually is not a problem. Okay, this is our typical entry. So we talked about this already, and a couple other things. You can also skew this thing. You can set it up if your outlook is bullish, and you feel like maybe the market has hit a short-term bottom, and you really think we're going up from here. You're optimistic for whatever reason. You're bullish. What you would do is pull your upper leg in 5 points, and it elevates this line to the upside. Let me get my pointer here. It elevates this line to the upside if you move this leg in 5 points, and it drops it a little bit in this area. And so what you see is that gives you much more protection on the upside. If you think, if I had it to do over again when Trump was inaugurated, I would have put on this trade because the market just ran away from me to the upside. And so this gives you a lot of protection to the upside at the expense of dropping this curve on the downside. But in practice, this seems to be a really good entry, and the reason is if the price was here and we started a downside rip, the changes that happen with Vega and volatility can lift this line to a certain extent in this area. So this provides more safety on the downside than you might imagine in practice. It's hard to tell that just looking at the chart, but that's been my experience. I kind of like this entry. And so this is picking the strikes of 20, 40, and about 56 rather than 60. And so I hope this makes sense. Not trying to talk over anyone's head, but anyway. And so this is the way you can monitor these trades several ways. Sometimes I'm looking at the monitor tab, and this is just a sample that I printed out. And so I can quickly scan the delta theta column here, and I go, okay, we got a delta of 3.7 and a theta of 17 over here. So that delta is easily under half of theta, and so this trade's probably fine. And the same thing down here. We got a delta of 26 with a theta of 87. So let me see. That's about 30%. That's getting up there, but the trade is still fine. And you can see the P&L. And now a big thing that I want to mention, and this is important. John Locke says this over and over in his courses. Don't try to manage your trades according to the P&L. In this particular one, let me zoom in again here. In this particular trade, I'm up $1,300, but I'm down 212 on the day. Am I panicking about this? Well, the thing to do is look at your delta theta, and if that's okay, chances are the whole trade is okay. Now, another way I manage these things is when I'm on the move, I've got the Thinkorswim app on my telephone, and so I can just pull my trades up and just scan the delta theta columns and go, okay, delta negative 21 on a theta of 144. That's just a very small fraction of 144. I'm good there. I've got this little one going on here. I've got a delta of negative 1.3. on a theta of 14. So again, delta is just a very small fraction of theta. So using this method, I'm able to manage my trades on the run. I don't have to be sitting in front of a computer. I can pull out my phone and go, everything's cool here, and not worry about it. So, so these are just other ways of managing these things. Okay, so now I've got a case study, and this is a trade I placed on December 20th, just before Christmas. It was a 6-lot trade, so that's 6 longs, 12 short, and 6 longs. I placed this for the February expiration cycle. It was 58 days to expiration when I put this trade on. And for a 6-lot trade, this consumes $21,900 worth of buying power. Now, just starting out, I would not trade this big. I would just trade 1 lots until you get the hang of this process. But it didn't take me long to gain confidence in this strategy, and you'll see as we go why. Now, I've showed you this one several times. This is our typical entry. Unfortunately, I didn't get a screenshot of the entry in December, but the graph basically looked just like this. And so 8 days into the trade, this is what I'm looking like. And so let me zoom in here so we can cover. This is 8 days into the trade. This is, put it on December 20th. This is the 28th. And so you can see what's happened here. Oh, I've got a pointer up there. Look how this T+0 line has elevated itself above. This dotted line here is your 0 break even. And this T+0, 8 days in, has elevated. So I'm sitting in the middle of this huge range where I have no worries of losing money until we go above here or below here. And so this is a comfortable trade that I can sit in. I can sleep soundly, not worry about this. There's just nothing to worry about here. And so 8 days in, let's look at our delta theta ratio. Our delta is -3. That's -3.5. That's pretty small on a 6-lot. Our theta is 77, and so you can do the math here. 4.5%. Delta is 4.5% of theta. That there is just nothing to worry about on this thing. Now, eight days in, I've already made $1,600 on this trade too. Again, don't manage according to the P&L, but it sure does feel good to be up money after 8 days. Sure. Go ahead.
Delta divided by 77. So 3.5 divided by 77 is what?
The theta.
The theta over here.
See, I've rounded this off. There may be a setting in things to get rid of the points, because so I'm just you know, what matters is the stuff to the left of the decimal point for the most part. So I just rounded is all. And let me see. And I talk, okay, Falvey's rule. So Falvey manages these by looking at the delta changes of the short leg and the upper long leg, which we already talked about. So the short leg must not fall below 0.3 or rise above 0.5. Blah, blah, blah. Okay, so what I've done here is taken 427 and divided that by 10. And so our delta on that leg, this is your short leg here in the middle, this 2240 leg. And so 42.7. So I was just showing you that still is within Falvey's specifications. And my, you know, Falvey does not use this delta theta ratio to my knowledge. I've not heard him mention that. This is really a concept that I got from John Locke, and he uses it in different ways. But you can see, using these rules, the trade is still fine. I'm very comfortably under this profit tent. There's nothing to do here but go play golf and let time pass. And so, you know, I'm up $1,600 after 8 days and feeling fine. Okay, so what do we have here? This is January 1st, and let me zoom in again. Oh, there we go. Okay, January 1st. So this is 14 days into the trade. So you can see what's happened now. Let me see if I can point at this again. Now my pointer. Oh, no, I had it up there a minute ago. Anyway, you can see where I've got the lower break-even labeled and the upper break-even. So that is the range that the SPX can move around, and we really don't have to worry about it. I'm already up money in this trade. I'm not sweating anything, and you know, every minute that passes, I'm up money. And so after 14 days, I'm up $2,300. So I'm sitting at let me see, this is 10.8% profit after 14 days. You know, some people don't do that all year. I mean, I could take the trade off and put it on again. You could. I mean, some traders might. You know, I look at this and go, it's making money for me every minute. I'm really, the risk of it falling down here and me running into negative territory is kind of small. I feel like if the market did make that big of a move, surely I could get out of this before I was losing money.
The market did drop, I guess, with that 65 points. Wouldn't volatility go up and short volatility with negative vega? That would be a hit on our trade, probably be less P&L territory.
You know, Okay. What he was asking is, if we were to have a large break to the downside, would the changes in volatility essentially put us into a losing position, maybe up in this area? And you know, volatility changes in so many bizarre ways. There's a lot to studying the volatility skew curves, and to answer your question, maybe and maybe not. I have seen it do that, and you just don't really know until it happens. At least I'm not sure.
Sometimes that entire
I've heard Andrew Faldy discuss this exact issue, and what happens is, okay, you've got an implied volatility on each different strike. And so, you know, some options educators teach that a butterfly benefits from falling volatility, and that is too simplistic of an explanation. There's a lot more going on, and Andrew Faldy says that this upper strike and this middle strike have much more impact than this one way down here. And oftentimes in a downward burst, when you have a spike in volatility, it can actually raise this line. And so, you know, it can go either way.
if it drops down and the market settles, volatility out.
My goal is to get away from these before they get too scary. I want to be in the upper half of this, really. See, you were short these options here in the middle, and so, you know, normally if you think about doing something like a bull put spread or something like that, you were selling out of the money options. So crazy things start happening with volatility and bid-ask spreads and other things that may affect your pricing when your short strikes go in the money. Now, they're kind of close to being in the money right now, but I really wouldn't worry about it till maybe this area. When this, see how the slope of this begins to start descending? If we take a burst down here, I might just go on and take profits and reapply, rather than waiting and hoping that it all works out and I wind up back in here. I'm not sure about that. I've heard several of his talks, but not every one. I think that he exits at 30 days expiration regardless. I think generally he's taking profits at 10 to 15% return. You could probably push that higher. We'll see in this case study in a minute here. I was up as much as 22%, and I stuck around for more, and some of it slipped away. So, I think a safe number is 15%. 10% is even safer, but it's kind of a gray area, I would say.
Okay, 10.8. How much?
Well, I would say not a whole lot. Okay, a lot of it is due to the theta. Not much of it is due to the delta because we started out delta neutral. By starting out delta neutral, we are neutralizing any potential gain from a directional move. If you go buy stock, for example, and you own 1,000 shares of stock, and you graph that position on this chart, your delta will be 1,000. Well, if it goes up $1, then you make $1,000, and that's great. Well, if it goes down $1, you lose $1,000, and if it goes down $10, you lose $10,000. And so, in some ways, this is safer than owning stock. But anyway, to answer your question, I think most of the gain is from time decay. SPX has not moved a whole lot since we were in the trade. I think we started around 2270, and so we've gone down a little, but it wasn't the directional move that made us money. Yes. Well, okay, I'm consuming 21.9 in buying power, so that's the money it takes to do this, and then I'm just pulling my profit numbers from right here. This wasn't, I didn't actually exit the trade, so there could have been some slippage here. Certainly, commissions are not factored in. These transactions don't always execute at midpoint, so there could have been a little slippage, but clearly in the neighborhood of 10% is after 14 days. It's pretty good. You could double that and say, okay, after 28 days, I should be up about 20%.
Take about 5%. How much is it taking?
Well, let me see here. Oh no! It's excluding the cost of entering. This is.
Oh, did you have to pay $20,000, or was that your?
Well, they reserve that capital in your account. So that's the max loss. If the market made a huge move down here and I didn't do anything about it, I would have lost $21,900. But my hope and feeling was that I could have gotten away from it before it got that bad. I want to close them out before we drop below zero. And so anyway, so let me zoom out a little so I can see what's going on here. So anyway, so you can see the delta theta ratio in this case. Delta is still at 1, and we got a theta of 93. So theta has gone up. Theta rises as time goes by. Now, theta is your theoretical profit for 1 day of owning this. In actuality, it seems greater than this because I'm up that kind of money in 14 days. But anyway, this is just to show you how it works. And then this is a little math showing all these rules. He wants the short leg between 0.3 and 0.5, and my short leg is at 0.45. So I'm still within Faldy's rules, and I'm also still within the delta theta rule. Now let's see. This is 15 days. We had a sharp upward move. Now, how did that change our delta? We went from, okay, the delta is now 27. The day before, we were at a delta of 1. So that's how quickly your delta can change. Now, how many points did we move up? We were at 2247, and we're at 2270. So, you know, that's a good little spike to the upside. You know, I'm still about 10% up. So, you know, the spike to the upside didn't really worry me too bad. If we continue to the upside, you can see the slope. You can see how this curve descends on the upside up here. So I don't want it really running away from me, but, you know. So that's what happened the next day. Now let's just check our delta theta ratio. Delta theta ratio is at 30% at this point, so we're still okay there. Faldy's exit trigger of 0.3 on the short leg. We're at 0.36, so we're still okay according to Faldy's rules. We're still okay according to the delta theta. You know, rules for exiting are somewhat of a gray area. You know, the safest approach is probably to exit 10% and reapply your trade. Go ahead.
Down in the lower right, there's a padlock.
Sometimes I will, just playing with them. I've done these enough to understand how the time, you know, how the curve changes over time. But just as an exercise, you can do this in your own platform, is to set one of these up, and then you can advance the date forward and watch how this curve changes. Because when you first start out, it's a very kind of tight range before you go into negative numbers. So if you were to put the thing on today and then there's a huge move tomorrow, you could well be below 0. But as long as your positive theta, as long as your Greeks are still okay, you might stick it out, because you can see, you know, as I've shown, after 8 days, you're sitting on a huge range, and it just gets bigger to a certain extent as time goes by. This is 15 days in, and you can see what a huge range we have where we're above 0. So, you got something?
We got a comment from the chat room saying, "Hi Don, here are my findings as I trade this live. When I backtested from 2013 to 2016 using an exit of 30% just for the short, a 28% annual return with an average days in trade of 12. I used 5,000 for planned capital for 1 month." So here's a very conservative and great job. On average? For the short. Using an exit of 30% just for the short.
30% movement. And his return was what now?
28% annual return, average days in trade of 12.
Okay. Well, you know,
30% of short means the short moves to 28 or to 50.
Well, that's interesting. You know, my experience has been, it seems to me that, you know, the truth is I've only focused on this particular strategy since last fall, and, you know, my gut feeling is you can make between 10 and 20% per month. So, anyway, let's get back to it here. So anyway, this is 20 days into the trade, and you can see we're still pretty comfortably under our profit tent. We still have this huge range where we are above 0. This is 3 weeks into the trade. This is January 9th. Checking our delta theta ratio. Delta's negative 0.37. in this delta theta calculation, we are just not worrying about the sign on the delta, the plus or the minus. We just take 37 divided by 107 in this case, gives us a delta theta ratio of 35%. So we're still okay there. You know, we're up $3,100 after 3 weeks in the trade. According to Faldy's rules here, looks like delta is 30.34, so we're still good there. So nothing to do. You know, you could decide, okay, I'm up 14%. That's a pretty nice return. I don't want this thing slipping up here. You know, but I also look at the price chart. I'm not on the live platform, so I can't pull it up, but you know, if we had made a good run to the upside and I didn't think we were going much farther, I might still sit on this. You know, this is a nice return after 20 days. There's no denying that. So here we go, 23 days. The market's pulled back a little, so we're going up the slope here. It's a very, very slight slope, but it is a slope. So we were up here and we pulled back. So our P&L calculation, we're at 18% return right now. Our delta is negative 22 and our theta is 126. Delta is still a very small percent of theta, 17%. You know, I can have a trade like this on and not worry about it. It's just making me money. And so again, the safest thing might be to just close it out, pocket that money, but you know, everybody's got to make their own decisions regarding exit. I'm up $4,000 after 3 weeks in the trade, 23 days in the trade, $4,000. That's not too bad. According to Faldy's rules here, looks like the delta of the short strike is at 0.4, and his rules are 0.3 to 0.5, so that looks fine. You know, it would certainly be a logical thing to do to just pocket that $4,000 and say, hey, that was a good month's work there. But you know, in this case, I'll let it ride, so we'll see what happens here. Okay, 30 days into the trade. No, 28 days, 30 days to expiration. Okay, we've gone back to the upside here, but we're still comfortably under the profit tent. I'm at 21% return on capital here. I'm at $4,700. It's 1 month. So my delta theta here, delta is negative 65 to a theta of 132. So this is getting a little high on this delta theta, 50% now. This is when I should have taken profits. I did not. Well, I'm using the delta theta kind of in addition to Faldy's rules. Now, Faldy's rule actually, okay, we're at 0.34 on the short leg, and his rules is 0.3 or 0.5. So really, according to his rules, this is not an exit trigger yet. That's true. That's true. 30 days should have exited. I did not, though. I broke because I got greedy. Yeah, that's pretty much it. I was watching it ride up. I'm going, okay. Now, you don't want to think you're ever going to get up in here, but you do. You know, I'm only human. What can I say? Yeah, you know, the smarter way to do this is to stick to your rules, and I just want to show you what happens when you don't. Sometimes I do, sometimes I don't. $4,700 in a month, that's not a bad paycheck for the month. So I should have exited. I did not, and we'll see what happens here.
Black. Got 2 more days. 3 days.
Yeah.
Start at 80.
58 in this case. These things work fine starting at 80 days, by the way. But anyway, so there's that. So the next slide. All right, I've gone 2 more days, and what's happened? I'm up 23% return. Now I've been in the trade 30 days. I'm up 23%. I got $55,190 sitting here. My delta theta ratio. Okay, look at this. Now this is becoming a directional trade here. This is something that I always try to ask myself when I'm making these decisions. Has my non-directional trade turned into a directional trade? If the answer is yes, then the conclusion's obvious. I need to get out of the trade. So 74 divided by 136, we're at 55%. That's getting high. Let me see. According to Faldy's short leg rule, we're still at 0.34. So we really haven't triggered that one, but we have triggered the day's expiration rule. So anyway, I decided to say, let's see what happens. Well,
I know.
All right, you can see what's happening here. The height of this is expanding, which is great, and it would be really great if the underlying was trading down here, but the underlying is starting to run away from me to the upside. And so look how big my delta is according to my theta. So now we've gotten to 84%. This is definitely beyond an exit point. Still up $4,900. Hard to turn your nose up at that. And in this case, let's see, we have broken Faldy's exit rule on our short leg here. So this is what the graph looks like, 23 days to expiration. Next graph. Let's see. Still did not get out.
This is just a paper trade.
This is, well, it's a great lesson because, you just got to know when to get out, and sometimes you don't. It takes a lot of experience. I've had to learn various trading lessons over and over again, and some things you just can't learn unless you do them. So you see what's happened here. The thing has run away from me to the upside. I'm down to 11% return. I lost $2,248 since yesterday. I'm still sitting on $2,500, but man, it sure would have been nice to put $5,000 in the bank. But this is a great example. Okay, and look at our delta theta ratio now. Our delta is 116 and our theta is 52. So we have way gone beyond our limit of 0.6. So there's nothing to do here but just get out of it. And I'm still up money. I screwed up on the trade is the truth of the matter. I still put money in my pocket.
Make money.
That's true. That's true.
Do it good.
That's the lesson here. Is even though I really bungled it a little bit, I still put some nice money in my pocket, and certainly the thing to do here: close the trade, put on a new entry, and then so I think I gave it one more day, hoping we'd break back to the downside, and we didn't. I think we did. No, I made a little more money here. I'm up to $3,100 since the previous day. I'm up to 14% return in 37 days. That's still not a bad return in 37 days. It's just not. Yes, it would have been great to be down here and make $10,000, but it just didn't happen. I'm clearly in a directional trade at this point. If you are hoping it goes down, you're directional, and we don't want to be directional with this. And so I still made a handsome profit, $3,100. Could have been better, could have been a lot better, but anyway, that's the way it played out. So this is an example. Now, just as a little exercise in what's possible. Now, there are a lot. There are a lot of problems with this model. One of them being you never lose. But if you made 15% a month and you compounded it, so your trade was 15% bigger every month, you could turn $40,000 into $1 million in 2 years. So I will admit there are some problems with this model here, but you never know. You can't do it unless you try. So that's right. That's right. That's right. So anyway, we have a few other little footnotes about Andrew Faldy. He has a trading room. It's about $150 a month, so it's not cheap. But he'll give you a free trial. So there's the link to that if you're interested. Personally, I think this Andrew Faldy is a really sharp guy, and you could learn a lot from him. And I didn't pay for any of this stuff. I just applied what I heard from a few webinars to what I already knew. And so, if you want to dive into this further, there's his trading room. He's got a systems workshop. This is something else. This is Options Tribe, and you can join Options Tribe and get all his old videos, and he's done quite a few in Options Tribe, and that would be worth doing. And you can do a free trial there and probably see most of them in your free trial if you wanted to. So these are just some resources here. And then he's doing a paid seminar in New York City in May on this approach, and there's his email address. And anyway, there's my email address if you have any questions. And so,
do you know if anybody has tried this one?
It's not going to work on weeklies, and the reason being is the gamma. If you try to set this up on a short-term trade, the slope of your T+0 line is very tough to manage. And part of the beauty of this is the very flat T+0 line. So we don't know which way the market's going, but in either eventuality, we're pretty safe because there's just no slope to our line. Maybe we go down a few bucks, but we're not going to wake up to a staggering loss. But if you do this on weeklies, you will get burned. So yes, do not try this on weeklies. I'll just tell you.
Add that it's very difficult to find right health strike on something really close. Everything kind of gets so close together. You're not going to find it.
Do not think that you're going to outsmart this guy.
How about on something other than
Something other than what?
equity instead of index?
I've actually done this on Amazon, and it worked just fine. And so I think probably some of the bigger stocks, you might try. Like I said, Amazon worked. Google may work. Some of the big ones. I haven't really tried it on that. My gut feeling is because the dollar amount is smallish that you're not going to have so many steps between all the different strikes and the delta. The steps between the deltas is going to be tighter because the steps between the strikes is tighter, and I think you're going to want an instrument that's at least got a big dollar value and is heavily traded in the options arena. So, I haven't traded RUT. I did see a conversation about that in Capital Discussions, and I've tried to model it out in RUT, and the slope of your T+0 line drops off much quicker than it does in SPX. And I think it has something to do with the way the implied volatility distributes out over the different strikes. Well, I think as you move farther away from at the money, it's just lower. Can't really explain it, but I know it drops off. And if you try to apply the same rules and model one of these out in the RUT, I think you'll see that the slope of your T+0 line is noticeably more, and so because of that reason, I've kind of stayed away from that one. But the graph looks great in Amazon, and I did one that way, and so you might consider that. You know, the benefit of trading these in the indexes, though, is the 1256 rule. Gains are taxed at 60% short-term, 40% long-term if you are doing this in an index. If you make money in Amazon, that rule does not apply. It's all short-term capital gains. And so that's a big incentive to stick with the indexes. And you got earnings, which could cause trouble. And you know, doing this in Amazon, I really only did it one time in Amazon, and earnings were approaching, and the run-up in volatility approaching earnings seemed to help the trade. So, you know, that certainly might be an area for further study. But I've only done one in Amazon, so anyway, something to think about there. Yeah, we'll post them so you can study the stuff. All right. I guess that's all for me.
Have a nice day. Terrific. And let's also have a hand for Ryan, who's going to talk on backtesting, the very same strategy. So let's have a hand for Ryan. Welcome.
I'm actually going to turn.
Is the echo still going?
Yes. Yeah, it will be. If I turn this on, it will be.
Okay.
Okay. All right, guys. Can you guys hear me okay online? Everything good? All right. Excellent. So what I've done is I've actually backtested this strategy. Now, I didn't do the delta theta ratio because that wasn't part of the original, faulty design. But I will go home and do that here. That was an excellent enhancement. Okay. So here's our disclosure that we typically have for capital discussions. Educational purposes only. So my trading career, if you guys haven't heard this before, I'm actually a full-time software engineer, so this is more of a hobby for me than a career. And I use some of my software development skills to produce this presentation. So I've been trading options only since March of 2016, but I've been swing trading for about 10 years, since 2006. Once upon a time, I day traded futures, and I've programmed several technical indicators and backtested many strategies, including this one today. So here's a picture of our 60-40-20. You guys are very familiar with this graph. What I've actually done here is you can see in the bottom, I've actually broken these up into 3 different strikes. So you can see our delta there for each one individually. And then this one is double, so 40 times 2 is 80. And so that explains that. And then this is actually an alternate way. So this is, I believe this one is, make sure I tell you correctly. Okay. So this is 50, 30, 10. Right? So I played around with different types of delta strikes to see which one would work best. I actually did many other different variations. The idea is that they're always delta neutral, right? So, the 30 there times 2 is 60. and then 50 and 10 is 60, so it zeroes each other out. So I've tested several. These were the two variations that worked the best, so I'm going to show my results for those today. But this is what this variation looks like. As you can see, it actually places much closer to the money, and then you have your tent is much further down. So on the previous slide, 60, 40, 20, you can see the one standard deviation line is way back here. On this one, it's actually here, like sort of the back end of the tent. So this is kind of a safer trade, but you're not going to make as much money. So you take on less risk. So it depends on what your trading style is and sort of what your anticipations are for what the market's going to do. Okay, so every great backtest starts with data, and so you got to download your data from somewhere. So I downloaded data from the year 2000 to 2016. I actually only tested through 2015 because I had a partial year for 2016. So I downloaded all my data from iVolatility, and then I imported it into SQL Server, and then I programmed it with using C#, .NET, and then I smoothed out the prices using Black-Scholes and Volatility Smile, just to get a nice smooth curve there. And yes, correct. And then so this equates to, since it's 2015, it's about 4,000 trading days, and I tested over 100 different variations of this broken wing butterfly strategy. We're going to review the summary of those tests today. Yes, SPX. Okay. So I have actually two different types of backtests that I did. I'm going to explain the first one now. The first one, I only ever entered one trade at a time, and my delta entries included 60, 40, 20, and 50, 30, 10. So that was, and then I also explored different types of DTEs that I would enter to trade. So Mark talked about always entering at like 60 or 85 days out. I tried 60 days out, 45 days, 30 days, 15 days, just to see, when you should enter this trade. What is the optimal entry? And of course, I did the permutations across both types. And then what I said, if I could not find a strike, such as, like I said earlier, if you're 15 DTE, you may not find the right set of deltas to, enter the trade. I went out in time a day and searched again. I'd also go maybe up or down like a strike, like 59 or 61, and choose that. But if I couldn't find anything close to, 60, 40, 20 or 50, 30, 10, I would then move out and search again.
Move out one day to find a price, or you would wait a day.
I would move out a day to find a price, so I could enter that same day.
Okay.
Yeah, I'm sorry. No, you're right. Yes, I would actually wait a day.
Okay. So if you're like, all right, we're going to test this 60, does strike, it wouldn't happen at 60 or whatever. So I'm going to wait a day, and now I'm entering if I have something.
Right. Yep. And then, exactly. And then what I would also do is I would exit at a loss. So if it exceeds 5% of max risk, of your Reg T risk. Okay. So I found that if you didn't have this exit, sure, your delta exit would take you out of the trade, but sometimes a little bit too late, and you may lose a little bit more. So I just like to kind of cut my losses there. And I played. Yes. And Baldy also has that, yes. I tried with it off, and it was either 2.5% or 5%. I think it was 2.5%, or maybe 2.5% to 3% on the entire account, and maybe 5% per trade. Yep. And I tried to take it off, and it like I said, it didn't help. So I kept it in. And then of course the different delta exits for the center strike, I chose 20, 30%, all the way up to 80%. So these are all my permutations. I did not worry about the strike that's in the money, or closer to the money, or the one that's further down to upper or the lower. I just concentrated on the center, and I actually found that the center strike was really the only one that ever knocked me out of the trade anyhow. I wrote it originally with looking at the other strikes and putting 30% rule on the other ones, but the center one always knocks you out first. So that's what I went with. Okay. So how did I calculate profit? I started with $100,000 in the account, and then I kept increasing my lot size until it got to the full size of the account. Okay? And then once I put on a trade, and I was either kicked out by the 5% rule or whichever rule, delta rule, I would then either add the profit or subtract the loss from the account with each trade. So we're continuously accumulating more money in the account, assuming we're winning. And in the next trade, I would actually use the full amount of the new account size. Okay. So this kind of goes back to Mark's graph of making $2 million in 2 years. If you never lost, maybe this would simulate that. That didn't actually happen, but we'll get to the results in a minute. And then you can exit of course, stop trading if at any point you completely wipe out and you lose all the money in the account. But basically, if you can't make another one lot, then you just cut that strategy, throw it out, and jump to the next permutation. And then I always booked profits in the calendar year in which the trade was closed. So if I put it on in mid-December and closed it in January, I booked it as profits for the following year. Taxes? No. It's a good question. Yeah. That's always something to consider. And then I basically outputted a bunch of statistics, which I'll show you guys in a minute, where I show the average DTE per year, exit DTE, days in trade, the average profit on our max risk, that's reg T margin, the maximum loss on a single trade, and then I also kept track of running drawdowns. Okay, so these are running consecutive losses across many trades. So I did not take commission and slippage into account with this, so that would be a good thing to add. And then of course one of the annual stats I have them calculated by year, profit or loss for the year. And then also I have a summary of stats. So I have the average running drawdown. You could also obviously have the max drawdown if you wanted to for across all years. Average return and annualized return. Who can explain the difference between annualized return and average return? So it's my understanding that annualized return, especially when you're compounding your profits like this, will be lower if you take a big hit to your account early on in the early years. So your annualized returns will be lower. So you may have a set of returns that each average out to be the same, but if you have more losses at the beginning, you're not going to. You're basically not going to. Your annualized returns are going to be lower.
Is your average return then the average of your?
Yes. 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 Exactly.
So your annualized return would be the compound average. The compound annual.
Right. Then I actually made a point to track large losses. So I thought, well, what happens if I get a large loss over 10% and it knocks me out? What would happen if I kept it for a day or two? Does the market bounce back? What is the behavior of the market? Many times it would bounce back and you get back to break even. Other times it would just keep going south and you would lose a lot more money. But I took note of that and I tracked it for 3 more days and I reported the results. Okay, so let's take a look at some of these.
Even when you sold it for a loss,
Yes. In my results, I still basically counted as a loss on that day, but then I just tracked it for a few days. All right. So here is what I call the carry profit forward style test, which is what I just described. Okay. And here's the summary. All right. Oh, it's on the wrong screen. Hold on. There we go. Okay. So at 60 DTE, with a 60-40-20 delta trade and a stop of 20%. These were the results over all the years, from years 2000 to 2015. So our average drawdown, is 11.9%. Average return is 22, and annualized return is 19. You can see then with the very next permutation, I actually increased that center strike delta stop to 30% as opposed to 20%. So by giving it a little bit more room, I actually increased my average and annualized return. At 40%, it's about the same, maybe a little bit not quite as good, but at 50%, we're now looking at 50% seems to be the best thus far. Average returns and annualized returns are large, but you also got to look at this drawdown, right? So the average drawdown is larger as well. 60% return, now the average drawdown is getting really high. And personally, any average drawdown in a strategy over 20% is pretty high for me. That means you're getting some really big drawdowns. We can look at the individual years as well. I'll show you that for each one of them. So what I can do is just, I'll keep scrolling through here. We get to 80%, and now it's like 30% average drawdown. And notice that our annualized returns are really small. So this 80% is just way too wide of a delta stop. You need to get out of the trade much sooner. That's what that's telling us.
Is there a basal expiration?
There was not. So I did have, in Faldy's original design, he had a 30 days to expiration was when he would get out.
Right.
I programmed it that way first. And honestly, it actually helps the system more to just let the delta strike take you out, because you would basically get a couple more days in there, and then you would get some nice profit. And if you got kicked out with a delta strike, actually the 30 days was too conservative. It depends on what you're going for, though. I mean, he trades a hedge fund, millions of dollars, and he's got an investment to protect and everything else. There's no DTE. This is just the 5% rule and the delta rule. No profit targets. Targets as well. And again, it didn't seem to really help. I tried 15%, 20%, 25%. So that's something to definitely think about, though. Okay, so this was 60 DTE, and it looked like something around the 50% stop was the best to go with. Here we're now at 45 DTE, so we're not entering as far out, and we can see here that if we're generally just kind of scanning through, again, right around this 50% seems to be the best. The drawdowns are now getting higher, though. I think before it was 18%. So like here now, almost all of these are over 20% or close to it for the average drawdown. Getting kind of risky as we enter in closer to expiration. 30 DTE now. There you go. 30 DTE right here. So again, we're seeing a trend here where, what's the best one here? So 30% seems to be a pretty good one. Much. Now that we're actually entering in sooner, our gamma risk is higher, which means that some of these larger delta stops actually hurt us more. Does that make sense? And so being more conservative is actually better when you're entering in with less time to expiration. And then 15 DTE. Well, this is really atrocious. We have 15 DTE. Now you're looking at like average drawdowns of like nearly 50. That's average drawdowns, not max drawdowns. Average drawdowns, like 50%. And this one, 15 DTE, was 80% stop. I literally ran out of money, and so it stopped the trade. What's your definition? Okay, let's go into that. Good question. All right, so let's just pick one. I'll pick. So this is a list of all the individual years, right? So here I have, 2000 to 2003, and I'm listing the average DTE and the max drawdown here. So this max drawdown is what I'm talking about. So the average drawdown, it's the average max drawdown across. Yeah. So for each year, I track the max loss, average profit. So this profit is profit on return, on margin, on max risk, break-even margin. That's for across every trade. And what you'll notice is some of these numbers are really high. So the total profit here is on the total account size. So remember, I'm trading with each account with the total account size. And if I get down here, so 2006, we had like a 10% loss. The first loss that I've seen, 17%. 2008, 2009 actually didn't do as bad as you thought. I think they might. Now this right here is interesting. 2009, 367% return. What's going on there? So I had to really study this, and what I found was that there was like one trade which made like 100% return on risk, and then another one which made like 50% return on risk. And so one of two things happened here. Either the data is wrong, and it could be wrong, or the data is right, and these trades actually accrued that much profit. So if it's right, the only explanation I have is that, remember in 2009, that was right after the election, and the market tanked and bottomed, I guess, in March of 2009. And in 2008, I entered a trade. The one that actually made the most money, I entered in 2008, and I guess that I took the profit in 2009. So I booked it for 2009. And then I entered another one, which also had a really nice profit. And then there's a couple small losses and a couple like 10% wins. But the only thing I can think of is that the vols during that time were just through the roof. And as a result of, we pick our strikes based upon delta. And so it made our butterfly really, really wide as a result of the volatility being super high. And so that's one good thing about the trade, is that it actually kind of adapts along with market conditions. So my guess here, if the data is correct, is that I had a really, really wide butterfly, and that protected me and allowed it to be, pretty profitable during this time. So that's something to be studied. And so what I've actually done is actually ran the same results without 2009, just to kind of take that year out. And I can show you that as well. The thing you'll notice is it's almost identical. It doesn't really matter 2009 is in there or not. What we're noticing here is that between this 40, 50, 60 kind of stop out range seems to produce the best results with the least amount of drawdown. You see that across the board with some of these, even at 45 dB. One thing I will also show you on that last slide was that these average days in trade and average exit, DTE is actually much lower. Days in trade is higher, and average exit DTE is lower than some of these other ones. See, these are like in the 40s. This is trades actually really just hung in there for a long time, and really got some good profit. And then what I do is, if you want to look down here at 2015, 2015 was a good year, basically across the board for this trade. I know Andrew Foley talks a lot about 2015 and his backtested externally, but I think in some of these other studies, we'll put one that's pulled up to 30%. 30%, 60. 2015. Yeah, this is basically the scenario that he has from the presentation. So it's over 100% in 1 year. It's pretty good.
That's because the market didn't go anywhere in 20. Yeah. It was flat all year.
Yeah.
I mean, everybody says these trades are not that is where the hedge is. That's where you can make the. So it's not a direction agnostic trade at all. I mean, it's a bet that the market won't go anywhere with some insurance, a little bit of insurance.
Sure.
Zero on it, right?
And as soon as the market does go somewhere, you get out of the position and you reposition it immediately. So
The market's moving, I'm out.
you're out and you put on a new trade.
Is that right? Is that an overall? Is that an accurate assessment of the trade or not?
Yeah, it's not a directional trade. That's good.
Yeah, like, got a margin of safety. So, once it's only 12 days of the trade, does that mean that like 35 trades?
That's the average days. Yes, exactly. You have a lot of trades in 1 year. Yeah, so this one is a 30% delta stop. So the average day in trade is like 12. But on this 50% delta stop, the average day in trade for that year is 24.
So, area
Yeah, you get knocked out of a trade, and then you actually put on a new one. I can't remember if I did the very same day or the very next day. I think it was actually the very next day. Put on a new one 60 days out. Yes. So if it's what it is, if it's 60 days out, if there's not something available, then it goes like 61, looks 62, and tries to find the next expiration 60 or greater out. Yeah, exactly. So that's actually the answer to your question.
And you see, Dave, what will happen is if you're kicked out with a small loss, then when you place your new order for replacement by going further out, the volatility will now be very high. So you'll already be taking account of the volatility. And so as long as you can maintain any individual loss small, you win still, even in a sharp downward. Matter of fact, many of these trades say they do best in
what's the max loss overall? Because to me, that's that would cause somebody to stop. And I'm not sure.
Mm-hmm.
1 year it goes down, I don't know, 40%.
Yeah. So that happened in 2008 right here. So in 2008, your max drawdown was 40%. It still made 18% per year. But that is like that doesn't.
Isn't one of the main factors. Can you keep doing whatever you say? And if it's got psychological flaw, which is like one big bad year, then
Yeah.
you can be able to keep
you
doing
can't tolerate that kind of loss. And Bobby does not, but it's
Right.
just outside the scope. But he has other mechanisms to handle it.
He does.
That's about the same for a year. That's down 40. 2 months.
That was consecutive trades, not one trade. It's all consecutive. Or multiple, not who knows how many. Okay. So then there's large losses. So here's a series of large losses. And I just kind of track it. I say, okay, on January 28th of year 2000, the market had a 2.7% move overnight, right, on 1 day. I lost 15%, took me out of the trade. But if I were to track it, the market actually went up 2% the next day, and then up 1% the day after that. And this just shows you what happened to the position. It went from a 15% loss to a 3% to a 12% gain. That's gain on your regular margin.
So in the back end, market moves right like that.
I booked this.
Negative 15. And normally,
Right. Well, yeah. This was greater than -5. Right. Exactly. So this knocked me out. You're absolutely right. Or it may have been the delta too. I'm not.
right.
Yeah.
Right.
Either one may have done it. So this is what I booked, and then I tracked it. So here's a couple other ones in there. I mean, here's a nasty loss here on Reg T margin, and then the market rebounded. But there's a couple in here, if I can find one for you, where it crashes and it just don't. Yeah. Here's one, 3% down one day, 1% down the next. You went from a 16% loss to then a 22% loss before it bounced back up 4%.
So if you could hedge somehow on that negative 5 happen.
So that's a good thought. Yeah.
Yeah, that's what Paul does.
Okay. So before I run out of time, I want to talk about the next backtest. So what's wrong with this approach? What's wrong with this strategy? Leveraging the whole account. Okay, that's not always a good thing to do. What else? There we go. All right. Well, it's entirely path-based, right? So you're only entering one trade at a time, and so that's keeping you from all these other trade opportunities. Plus, you're adding it to your account or subtracting from your account every time. So each trade is not measured; they're not equally weighted, right? And so that's really going to skew your results, or will it? I don't know. Find out. So how can we alleviate this problem? What I'm doing is I'm not carrying the profit forward in this next backtest, or the loss forward in the next trade, and I make every trade the same size, $100,000, and then I place a new trade every single day. Of course, you'd never do this in practice, but this gives us a good statistical, measurement of our trade, of the strategy. And the only time I don't enter the same trade is if I actually already have this trade on the book. So basically, I hash the trade based upon the date, the DTE. The expiration date, and the strikes. And I track them all individually and in isolation. Okay? And then I can't quite, show the same type of statistics that I do in the previous one. So I can't do like max drawdown. That's a little bit odd when you have a basket of trades on at the same time, and then they all get wiped out with one market move. How is that really measurable to some other basket that you have on later on in the year? So I don't include max drawdown, but I do include max loss on any individual trade. And of course, average return on margin for each individual trade, as well as average DTE and days in the trade. And then for all the years combined, I have the profit factor, the percent winning trades, and then the average return on margin. Okay, so let's look at that. Now I'll post all these results so you guys can take a look at them. Okay, so here's the summary. What I'd like to do, if I can, kind of split this here, get rid of that. Okay, so on the right is the new one, where I enter every day. And on the left is the one we just looked at, where I carry the profit forward. Okay. So here is the 20% stop, and notice the profit factor is 1.8. And if we look at the percent winning trades, these are the numbers we want to have go up. We want our average return on margin and the percent profit factor to be higher. Percent winning trades kind of stays in this 55 to 60% range for the most part, but really we want this first number and the bottom number to increase and pick the best one. So here profit factor is 2, a little higher. And then notice we get down here, and profit factor is now at 2.27, and the average return on margin is well over 3% for both of them. Okay, so this just happens to coincide with what we chose to be the best parameters for the 60-40-20 in our carry profit forward. But notice one interesting thing. This up here that we were kind of debating, well, this annualized return of 27 versus 28, and this average return of 43 versus 41. Well, at first, this looks a little bit better with this lower drawdown than this 18. But when we compare it to this, we see that, well, maybe this up here is actually path-based, and all of a sudden it starts to jump out at us that, well, maybe this 50% delta stuff is actually better, because this average return on margin of 3% is certainly better than 1.5, and the profit factor of 2.27 is better than 2. So that's how you can kind of decipher the summary of backtest. I'll go down a little more. No. Just generating more data.
To say, right, you entered that one. Right. What if you were doing something else that day that was super important, you couldn't get market out? Now I can, like, does that action of waiting gap go with a backtest like testing one day get more if action matter one path goes out, that would have more path.
Right. So this one may have just gotten lucky. So let's go down so you guys can see the rest of these. I'm not going to scroll to the one on the left here. You guys can compare them later. But where we get to 14 DTE or 45 DTE, all of a sudden our average return starts going down, our profit factor starts going down. If we look at average return, nothing's actually over 3 at all. In fact, it gets pretty low here. Closer we get to expiration when we're entering. So low, in fact, that some of these barely can get over 1. Okay, well, this one's bad. So this I would expect to be worse. Actually, and then, of course, there's the 50-30-10, which is a little bit more conservative. See how conservative it is. So I think, but again, it's a similar pattern where this 50% at 60 DTE seems to be the best, really. And that shows us that those parameters are just really good. It doesn't matter which delta strike setup you're trading. Somewhere in here seems to be a sweet spot for trading. So scroll down more. And then, of course, the results look like this. Again, this is a max loss on any one trade. That's a max loss on the reg T margin. Remember, they're all the same, $100,000. And the average return on margin for each year. Some of these years did really well. Let's look down 2008, 2009. Let's see. All right, so 2008 had an average return on margin of 3%, and 2009, 12%. Pretty great. Let's look without 2009. See what it would have been for the strategy. We're looking at about 2.25, where the other one, I think, was actually put above. Yeah, 3. Yeah. So so 2009 actually did significantly increase your results. So it's with any backtest, it's really important to kind of look at your outliers and figure out, like, well, why is that happening, and is this important to? Should this be a part of the test? Should it not? But even without 2009, you can, these parameters still hold up. Per trade, yeah, average return on margin per trade.
Every time you risk $1,000 on average, that's 28.30
28.30.
on
Yeah.
average. Not an average, but all your trades that year. So what was like what's up?
So the annualized return is actually can be tracked from the first set of results a little bit better.
Well, that's
right. Yeah. You wouldn't be trading a trade every day, so it's hard to really say what that would be.
No, but it's called as representative.
Oh.
It's called trade 12-month period.
Yes. Sure. Yeah. It's not exactly. Yeah, if you only had 12 on, if you're doing it every month, you could calculate that. But some years have a lot more trades than others, so it really wouldn't be fair to measure.
for your profit factor. I mean, doubled it, 2.05.
Yeah.
So for that strategy, for profit factor 2, say a strategy made $20,000 for all the losers bought $10,000, 20 over 10. $2 in gains for
Yeah, so Mark's saying that, in his experience, he's had some really good wins. And I actually have too. I mean, I've put on 3 of these, and each one, I think it maybe should like it, each one was well over 10%, between the 10 to 20% range. And I think we've just been in a really great time period to trade this trade. I would not expect that to continue indefinitely. I mean, obviously here we're seeing like 3% average return, so you're going to have actually a lot more small losses than you will big wins, but those big wins certainly outweigh, as you can see here, it's 3% on average.
you're directly to trade under a different standard.
Yeah, he has different trade rules too. Yeah. So I'm actually going to go home and program the delta theta ratio into this. See what happens.
You're going to have a lot of small losses.
Yeah, there are some that too. Yeah.
Yeah, remember that's 15 years of trade.
You got that. Outliers.
Right, and then that's actually why I chose. That's why I started at 2000, because I wanted to get 2 complete cycles, two bear markets. The trading today? Well, it actually translates. Basically, it's the same strategy that you saw earlier, and so, like, you could basically just enter a single trade, and then once you're knocked out, you could enter in another one. Just go 60 days out and put another one on. Mainly like this carry profit forward trade is really what you would be doing in actuality if you were doing this yourself. Because you wouldn't be entering a trade every day. This just helps you find the right parameters for the trade. Does that make sense? All right. So we're almost out of time, and I just wanted to see if there's anything else here in my slides. Okay. All right, is there any more questions about this? How much variation was there from year to year? Yeah, I wish I had a really good visual for you guys. I wish that I had time to actually put this in like a bar chart or a line graph or something and show you the differences in profit between the years. That would be a good thing to do. Maybe when I post my results, I'll do that for you. Oh, sure. Yeah, like what is the max profit per year? Yeah, you could do that pretty easily. Absolutely. Yeah, I mean, you're welcome to take a look when I post it. Just grab any one of those text files and just find the max or the worst profit. Right. Okay, so what's next? Well, what I really like to do is put some trade filters on this strategy, and maybe I don't enter the market every time. Maybe it's just a bad time to enter the market. So you can do that a number of different ways. Brian Johnson has a really excellent book on some trade filters that you might use for backtesting. He'll probably talk about that in the next meeting. So that's one thing I could do. And then maybe backtest a different strategy, such as the road trip. I really enjoy trading the road trip. And, this change your Faldi's net zero 60-40-20 is an excellent trade. It's very easy and simplistic. But I actually really enjoy the road trip because you can kind of tweak it and do different things with it, which is just fun. So maybe I'll backtest that and see what the best modifications are for the road trip. Yeah. Yeah. Slippage and commission is important for when you're backtesting a strategy that has adjustments. Absolutely.
So, like you were alluding to the fact that a couple that override a lot of the costs are for craft this many. The reason why I asked that, again, that's a market factor, and it's also a trade that has one big winner that you need to get in order to make up for all these velocities is, in my opinion, psychological trade over the long run. Exactly.
Yeah.
Real trouble. That's exactly right. So that might be interesting. Yeah.
Right, and maybe that's a good, maybe you find out that really the 20% delta stop is more conservative, and that's the one you should be trading due to psychological cost alone. Okay. And then I was thinking maybe it would be really nice to program like a T+0 payoff diagram. We have lots of people that are actually interested in that, so if you are, please come talk to me after the meeting and to track my position. And I'd love to get into like a really in-depth study of the put skew and all the different variations, the way that volatility can change with time. Okay, yeah, that's excellent. Well, definitely. Great. Any other questions? So I think that one of the next steps would be coming up with what indicators you could use. Maybe backtesting some indicators into the strategy, finding out what would be optimal as a tool to determine whether you should enter or not. So that's next. All right, great. Thank you, guys. Oh, one more.
How much was the data?
The data from high volatility, I actually downloaded data all the way back to 1990. I essentially just got everything they had on FTX. And then their prices were like doubled or tripled. So I spent like $300, $350, something like that. It wasn't terrible. Maybe it was cheaper. I can't remember. It was a while ago. Yeah, end of day data only. Yep.
What were you saying about it?
Don can actually talk more to that about the the price adjustments?
Well, okay, thank you. Well, there's a lot of, the data is not high quality data from some sources that you get, really. In futures, you have settlement data that is truly very, very nice and very smooth. But for a lot of the data sources that, and I've also independently seen some data from this high volatility source, it's very ragged. In other words, it's not really meaningful for individual because you have things like you have bids only, asks only. It's just sort of a lot of times it's like the last trade rather than really any sort of settlement value. So just smooth it, and they already do. Most data sources already smooth the volatility. They draw a skew curve, volatility curve, and they don't back adjust the prices, but they're showing you what they think the real, I mean, implied volatility is a real is a price in a way, and by fitting a volatility curve, and then I back compute the prices from that. What is that right? And by the way, I also have run a similar tests. I have my own backtest results, but I thought it would be interesting to hear from Ryan, and it was very interesting for a change because I've already done lots of talks. And Ryan is going to do a road trip. I'm doing M3 now, and I've already made some progress in M3. And I guess there's the issue, like M3 has additional guidelines. John Locke has additional guidelines beyond what Faldy does. I mean, he's looking at the Vega. He says, well, the Vega's gone positive. I'm going to get the Vega negative again. And he also says delta has to be within a certain range. So it'll be very interesting to see because fundamentally the trades are not all that different. If you look at some of the deltas in Faldy, in Faldy's work, they're not all that far from 60-40-20. So really, I mean, it's the same basic as there's a lot more that could be said about all this, and we'll say it. Any other questions for either Ryan? Well, let's have a nice hand for Ryan. Could you kill the? Thank you very much for joining us on WebEx too.